Well, that was a good finish to what was otherwise a relatively bearish week, especially in the last hour, 2 hours of trading. Things really took off to the upside, and we closed with a relatively bigger range right at the highs of the day. Options expiration might have something to do with that as we head into a new options expiration cycle next week, and we head into a new month in February, and we finish out January, and we head into a very important 2 weeks. We have we have a lot of earnings due out. I believe 25% of the S&P next week. We have 30% the week after that. We have the FOMC the week after that. We have PCE, which is the Fed's inflation measure that they monitor the most. We have GDP coming out in this next week. We got a lot on the plate, and the markets appeared going into today to be settling in for what may be a good run to the upside, or one last failed attempt to break resistance. So I'm going to break down where I stand on that fence and which side of the fence I stand on, and what I expect that we'll see over the next couple of weeks going into February and then beyond into what is seasonally not the best time of year, and seasonally a pretty bullish time of year for volatility. So things should start to pick up a little bit here. So we'll talk about what my expectations are, look at some interesting moves and interesting correlations, kind of return back to some traditional correlations that we haven't seen in a year or so. So we'll talk about that, what's driving the price action. Then our trade of the day is a stock that really made a big move to the upside and has a big gap to fill. And we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, January the 20th, 2023. This is the market outlook from marketscholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, so if you're watching us here on our blog, check out some of these other things over here on the website, including some of our recent popular posts. And come down here and click on this heart. It opens up this tab. Hit that like button. And same thing, hit that thumbs up icon. It opens up that tab, and hit that like button. Again, that helps us get our content out to all of our followers on those platforms, and appreciate everybody who likes these videos day in and day out. All right, let's take a look at the S&P 500 with the market forecast indicator. And boy, was that a good close for the S&P. After a couple really down days here on Wednesday and Thursday, we rallied today into options expiration all the way up to the highs of the day, closing about 0.3 of a point off of the high of the day. Momentum line moved into bullish territory. Near-term line bounced up, both from pretty sharp lows that would be typically considered with bearish moves. You can see the intermediate line had dropped. It's actually still falling. The market sentiment line has turned down to and is now barely falling. And you can see the rally stayed above, or got back above, the 30-day moving average, but did not eclipse that 2.5% mark. So a nice little last hurrah, or maybe a last hurrah, a nice little rally. Again, I guess it would be the last hurrah for January expiration, right? We started January expiration right here. That's where we opened it, and then we can see we closed. We were kind of looking to close about at break even if we had continued this decline, but ended up with a little bit of a gain. We'll take a look at that here in just a second. So not surprising, short-term sentiment bounce. The intermediate line still below its market sentiment line. I remember the Dow Jones Industrial Average has been more bearish here lately, and not surprising today was less bullish. Filled in the gap from yesterday, finished filling in the gap from yesterday. Short-term sentiment did not bounce up very much at all. Remember, the near-term line follows the momentum line, and the intermediate line is now in the lower half of the chart. So you got dark pink shading and a red line as you're still below the moving average. Now the NASDAQ was the most bullish and has been up 3% today. You'll see here in a second. Remember, the NASDAQ has been unable, it's still below its 38% Fibonacci retracement level of this intermediate decline back here that we're still retracing, that we had tried to stop retracing here and started a new bearish move, but the reality is we're still retracing that. We got dark green shading and a green line, interestingly enough. The momentum line also got into bullish territory, barely. It's done this before, so we'll see what kind of bounce. Last time we had it right there we gapped up and then had a long upper shadow, brought the momentum line down and stayed down as the near-term line rallied, and you can see what kind of effect that had. Remember, it's still below its 38% retracement level. The S&P 500 is actually above its 38% retracement level, so you can see kind of why the NASDAQ would have been more bullish, because it had been less bullish that entire time, more bearish. Over here, it's like when we had actually started a new bullish move on the Dow that we didn't get on the others because it didn't go up as far. And now the Dow is, again, was trying to break back down below this 23% retracement and start another retracement. And today, just a smidgen back up above it. Looking at the Russell 2000, again, it's still in retracement mode. And like I said, it's easily above the 38. But you still have pretty significant resistance that it's hit multiple times over the last so many months in this area, and we are back up above it. The intermediate line is actually still in the upper reversal zone, so it hasn't dropped very much. And then you can see the market sentiment lines rising, intermediate lines above market sentiment, and you can see short-term sentiment bouncing back up. So different varying degrees, but obviously the Dow, which had been the most bullish, is now the most bearish. The NASDAQ, which had been lagging so much, is now the most bullish in the last couple of days. So it kind of gives you an idea. We kind of get an idea why things are moving the way they are. Let's go back to the S&P, and let's look at the weekly market forecast now. So you can see, again, very bullish short-term sentiment the last couple of weeks, and then today or this week, momentum line dipped because of the lower shadow here and the decline, but the near-term line stayed up as we rallied, and we came off of the lows of the week and closed actually closer to the highs of the week than we did the lows. But again, the near-term line follows the momentum line, and we'll see long upper shadows tend to be pretty bearish, and we are trading in that upper shadow after bullish moves. So long lower shadows are bearish too. They're not as bearish, but again, we can trade when you get a long upper shadow like this. You can still trade within its range and not really change the narrative, as we're still, like you said, easily above or sitting at these really important Fibonacci retracement levels there on the NASDAQ. The Dow, which has been more bearish, had more of a bearish week than the S&P, closer to the lows. And you can see the impact that's had. It's brought the near-term line and the momentum line down more. The intermediate line is still rising because of how bullish it is. And we still got dark green shading a green line for a lot longer than the S&P. So it's been a lot more bullish. I remember the NASDAQ is different. It's been a lot less bullish. It finally got the intermediate line to turn and give you dark green shading again. But you still haven't even gotten above the moving average yet, like the Dow Jones Industrial Average has. So again, good bullish short-term sentiment. The momentum line jumped up a couple weeks ago, or last week. The near-term line followed suit this week. Now you're getting, now we're hitting up against the resistance at the 38% Fibonacci level. Now it's just a matter of whether we'll break that resistance or not. Finally, the Russell 2000. Remember, it is above its 38% retracement. It's headed towards the 62 instead. And then again, you can see the strong short-term sentiment here. The stop so far at the resistance. And again, we've seen, this is not hardly unique that we've gotten this far above the moving average. We failed both times. We're less now than we were these two times, and we're still at resistance, at the same resistance we failed at last time. And the other time it was the fake out move there in August that, in the Jackson Hole smackdown that brought us back down. So here we are again in very similar scenario and similar environment. Of course, you have the options expiration cycle ended, so we can go to the options expiration period here, and you can see we got that bull tag. We talked about that at the last options expiration, and on the monthly chart as well. And you can see we didn't get very much of a bounce here. We didn't even get back above the moving average. We're still in this range. The intermediate line is still falling below its market sentiment. It's now out of bullish territory. You can see it dipped out of bullish territory over there. Like, it's not common for the intermediate line to dip out of bullish territory unless we are, either COVID or 1987, a big sharp decline and a real fast move, or you're in a bear market, right? You can see all the other instances here, however shallow the bear markets happen to be these two times. But these two bear markets in 69.70, 73.74, and then this one and this one are the only other times outside of 1987 and COVID where you had this pretty much a one expiration cycle decline there that eventually brought it down. By the time it got below, we were already recovered most of it. And then 1987, another instance where it was essentially a couple options expiration cycles. But by the time we had gotten below 60, we'd already formed a low. So here we are again, breaking below 60, but not because of one options expiration cycle. We've pretty much been declining for multiple expiration cycles now. And so again, another indication with the multiple bull tags, no less, that eventually, and again, you can see going back out to 2000, you can see once we got multiple bull tags, we didn't immediately roll over and get the dark pink shading and a red line. In 73, 74, we had 3 bull tags too before we finally got the dark red, pink shading and the red line. So we have to get below 50 to get the dark pink shading. We have to get significantly below this that 2.5% mark to get the red line. And you can see we are getting closer, and we are still below it at 1.7. So the odds are still that this will lead to more declines over the course of this upcoming year. Let's take a look at our other weekly chart that we pay close attention to. You can see the nice rally got a higher close. We did not get above the 40-week moving average on a Hakinyashi closing basis. We did over here and we did over here. We have not this go around. And you can see next week's open will be right around 39.38. We're at 39.72 right now. So we'll start off relatively bullish, though it appears the MACD down here, or the size of the candle, is starting to shrink and potentially get below its moving average. And you can see your PPO, 39.21 is not very far away from 39.72 to get a red arrow. So I'm leaning in that direction that next week we'll get that turn down to the downside, and you see it here on the whole. Let me go back to the whole moving average. You can see that when you look at the weekly version of this, here's the daily version. You can see we got the transition candle after a pretty bearish candle Thursday. We did not flip the parabolic SAR up. We're not red yet, but you would expect that we will. You can see the PPO, the MACD is still pretty high. You would expect it would continue to roll over. Now it's just a matter of Monday. Do we close above this body? Right now, the body for Monday's candle will be right around 39.38, and right now we're trading at 39.72. So where we close, and if and when we ultimately flip that parabolic SAR, will give us an idea of whether, when this thing will, if the thing will turn bearish. You expect that it will, as you can see the gap between the parabolic SAR, which has been below on the weekly chart for so long, is catching up very rapidly, and the PPO is not getting, the MACD is not getting much momentum, and the size of the candles is again approaching the moving average, and you can see when you break that moving average is when you start getting the bearish candles. So that's what the other weekly chart looks like. Looking at the 3 green arrow charts, you can see you're back to 3 green arrows on the S&P and the NASDAQ. You still have 3 red arrows on the Dow, which again, remember, that's been the most bullish for so long. Now it's the most bearish, and your Russell is actually one of the more bullish ones too, as it's got the dark green, the 3 green arrows again. So you've had some pretty good runs here on a lot of these, but the Dow is not really confirming that. And if you look at the 2-line version, especially on the S&P, you basically made another run to the 200-day moving average. And every other time we made a run to the 200-day moving average, in this case also the point of control, it's failed miserably. So, if we can break above 4,000 here next week and get closer to 4,100 and beyond, then Tom Lee rally, here we go. But if we fail again, and this was kind of a one last options expiration, pen risk, last hurrah, then we'll see ultimately how that ends up turning out again as early as next week. The DMI, we stayed above 25 in the positive. We dipped back down in the negative, but you still have a very low ADX. you really do not have a trend formed here. Whatever bullish trend you had is still having a hard time getting going. You're still inside the cloud at the top of the cloud. You actually still have a negative 26-day rate of change. Over the next few days, it could get positive if we don't have that big of a decline that essentially would get us below the cloud. And again, another reason why I think, as early as next week, we could start to really move this down. The RSI and the CCI are still in the upper halves of their chart, so still in bullish levels. But again, while this one got above 150, this one did not get above 50 or 60. So we're still not really confirming that bullishness on that indicator. Looking at the Bollinger Band, the Keltner channel, we are in the upper half of the chart, though not in the upper quartile. The bandwidth is relatively low, a lot closer to the 150-day low than the 150-day high. Even when the high changes, it's still a lot closer to the low point. And your Bollinger Bands are outside the Keltner channels, just barely. And so we'll see if that, how that persists to the upside. But the smaller bands suggest, the smaller bandwidth, suggests that we're going to get some kind of directional move. It's interesting that we are above the 50% Fibonacci retracement again. This one way over here that we started, when we first touched the 50% retracement back here to the downside, we're nowhere near those levels in volume. And when we touched it over here on this rally, again, we're above that level right now, but the money flow is not. And then again, you can see over here on this decline, we hit the 50% Fibonacci retracement level, and you can see we are above that price right now, the close of that day, yet the money flow is still lower. So even though the money flow index is still in bullish levels, it's the money flow itself is still not confirming the bullishness. So even we've had some good breadth here lately, a lot of really good breadth indicators suggesting. We even touched a smidgen above 100 on this little move to the upside. So even though we're not coming from below minus 100, which would be that breadth thrust, but still strong breadth. Well, yesterday we had dipped below 35, back below 35, but we bounced back up and got a good move here. The new highs and new lows index is also giving us, here, let me go to the new highs and new lows. The new highs and new lows index is also still positive, and the moving average is close to being positive itself. It never did get positive over here in August. But again, we also are approaching, the moving average is also approaching this level. This is the closest that these two, the actual new highs and new lows and the moving average, is the closest they've been in a while. Right, at least you can see when they gapped up and really created this big gap here, that gap is shrinking. And as that gap shrinks, we don't extend away, we open up to a break below that, which typically coincides with a peak. The skew being relatively high also, this spike in the skew up to 120 above the moving average, but sharply in the last few days also tends to coincide, if you've seen in the past, when you get these sharp rallies in the skew, with a strong momentum, it tends to coincide with peaks. You can see that strong momentum peak. That strong momentum was with the peak on the S&P. This strong momentum was with the peak. That one was with the peak. So you can see where the peaks coincide, and the skew coincides with some bearishness. These are some volatility, especially in this bearish trend that we've been in. And so here we are again with a strong momentum and a strong rally in the skew. Is it also going to be associated with a peak here? If we can get the number of stocks that are above the 50-day or the 200-day moving average here to approach, this is over the last 10 years, the mean is to get above 65%. So it looks like we should be getting to a really good number and get up above, and be really bullish. And we are at 62%. Today, but we're still not above the 65% mark, which really changes the tune and suggests that we are now indeed bullish and starting a bullish move. It appears to be at the peak, at a bearish peak in bullishness. If I were to go back 20 years, so you can see that same 2008 level. You can see you get good runs. In this case, we got up to about the 55% level. Here, let me do this. Let me go to, it would have been like around May of 2008. Let me do it this way so I can type it in faster. And we'll go like the middle of May. Try this again. Middle of May of 2008, and we'll go back to 1998. Yeah, let me do this again. Okay, I think I have this now. So at the time, the 10-year average was only 61%. So you can see the mean has moved up over the course of time to that 65 number. But in May of 2008, we had gotten above the 50% mark, and we were working our way back up towards that peak, but failed to get above that peak, and as a result, we stayed in the bearish trend. Failed to get above that mean, and again, here we are, same level now, or same 10-year chart, same level in the 60% range, above 50%, but unable to get above the mean, and as a result, as of right now, unable to maintain a bullish trend going here. Let's take a look at the volatility chart, the VIX. So give me 1 second to pull that. Well, here, let's look at this chart first. So we did finish with a higher high and a higher low. That late push higher with some pretty decent volume here at the end of the day got us up to the really strong levels there, finishing above last week's high. So again, it makes you wonder about that a late push like this going into a weekend, an options expiration weekend, no less. We did not get a new high, so the positive indicator is still dropping. The negative is close to being 0. The range is really low. If we can get a new high, then we can break out of this range and get it up, going to the upside, at least get above the 10%, which is what you like to see when you're on bullish moves, right? Getting above this 10% mark. The range is so small right now in the last 4 weeks, sitting there at that 6%. So we'll see how that turns out. When you look at today's range and volume here, the range was above the average. The volume was above the average. So we had above average range. We had above average volume. And you look at the VIX, the VIX dropped today. Not surprising, right? Because the market rally, the VIX dropped. Back below 20, which is an important level. 20 is an important level. We dropped below 20. Last Friday, and you can see what happened. We're dropping below 20 again. The correlation with the VVIX is still negative. The ATR for the VIX is still below 10. So all the conditions that we've talked about before, see below 10, all the conditions that we talked about before in terms of like building in the case for a compression in the volatility index that would suggest a move to the upside, that they're all still there, right? We don't spend much time below 10% on the ATR to the price on the VIX for a good chunk of time, even when you're below 20, right? You're typically up above this 10% mark, and when you get below 10, they either tend to be really bullish or just really low levels because we're so low. But we're not so low. We're above 20. And so again, the VVIX, when you look at it, it's down. It dropped down today down to 80. But again, really, really low level on the VVIX would also suggest that we're about to make a run up to the upside again in both the VVIX and the VIX. For the VIX to be as high as it is at 20 with the VVIX down as low as it is not common, and suggests maybe the VIX might be a little bit too low, and the VVIX might be a little bit too low. And that, again, that combination of both those moving higher is not typically bearish for volatility. It's typically bullish for volatility, especially when you consider the seasonality, which we've talked about before. Of the VIX tends to be really bullish this time of year, right? We tend to move off of these levels all the way up to March options expiration, which is 2 months away. That's when we tend to peak. So here we go, essentially, right? Here we go with all these correlations that have been, we were positively correlated on the VIX to the S&P 500 for a good chunk of time here, and now you expect that now that we're back to negative correlation, a jump in volatility index would more than likely coincide with the drop from these peaks, this level on the S&P 500. All right, now let's take a look at what's driving the price action. You can see over the past few months, international stocks have just been doing very, very well, especially developed markets. But both are up 20% or more, and just in the last 3 months. Of course, a lot of that has to do with the weakness in the dollar, down almost 10% in 3 months, which is insane. It's helped gold rally up 18%. It's helped Bitcoin rally as well, as we'll see. Has not helped commodities rally. In general, commodities are pretty flat. Again, goes to show, and they should be killing it in a weak dollar environment. And the fact that they're not says a lot. Like, the fact that commodities are still are pretty much, again, with a weak dollar, which is generally very bullish, generally very, very bullish for commodities. The fact that commodities cannot get going to the upside and instead are actually in correction mode. They're below the 50-week moving average. We've already gotten below it once, to it and through it once. We had a failed bounce, and now we're in correction mode, filling in this gap in volume here. A little bit of a rally up to the, above the 17-week and up to the 30 again. But very, very, look at the volume this week on this. Very, very weak move to the upside. You would expect this volume node to hold its resistance. And we continue to retrace. Again, commodities are probably a lot more bearish than that when you consider, again, just how weak the dollar has been over the past few months. Again, you look at the dollar and you can see the strength, the big drop it had last week, and then kind of a nothing move, very low volume, relatively speaking. The MACD is still below its moving average, so the histogram is still rising. And that means that when the histogram peaks, the MACD peaks usually follows suit. So you look for the MACD to bottom out here in this area. When the MACD bottoms out, the price generally tends to bottom out right at the 50% mark of this rally we've had in the dollar over about a year and a half. So it's basically just a 50% retracement of a very strong move that we had here. If you were to, let me get rid of this long-term one. And if I were to draw, let's draw this Fibonacci line and go from really about right here where it really went parabolic up to the upside. We're on the 62% retracement of that move, as well as the pre-COVID highs. So you can see why we're starting to run into some support in this area. Multiple important Fibonacci levels. Well, this Fibonacci level and then the 50% mark of coming off of this low point back here, kind of a double bottom low point. Those are all really important. That's where we peaked in the MACD. That's where we peaked in the histogram. And now we've had our retracement. And, you wonder, of course, the decline in the dollar has helped bonds rally. Bonds have rallied in the same amount of time. Above their 17-week moving average again for another week. MACD is rising, almost about to cross above zero. You've seen that reflected in a downward move in yields. Again, a third week in a row of declines in yields, down, finishing this week down 3.5%. The MACD for the 10-year yield is about to drop below zero. Of course, the histogram is already bottomed, so you wonder how much more downside there is to this. So you can see the stochastics is also declining, but slower, much slower than its moving average, and it appears to be setting up for a reversal there. It's going to be hard for, when the Fed raises rates for the 10-year yield to stay. Getting below 10% as we saw, or getting below 3.5%, as we saw, was bearish for equities. Getting back above it's fine. Getting back towards 4% is ultimately going to be bearish again, because that's what got us in this mess. And if we do approach 4%, which would not be surprising, that would, considering that the Fed's expected to move the Fed funds rate over the next 2 meetings to 5%. It wouldn't be surprising if we held. And if it broke 3.5% while we are in this rate hike mode, that goes to show just how much the bond market's pricing in recession odds as early as this year. So there's a lot to put here. And again, another one of those catch-22s that we have. I told you before, Bitcoin has really been benefiting from this decline in the dollar. The last 2 weeks, it's really kind of taken off. Two of the bigger moves that we've seen, if you look at the rate of change for Bitcoin over the last 10 days, a 2 week period, If you look at the last 10 days here, 1, 2, 3, 4, 5, really 6 days. Let's go a 6-day rate of change that encompasses all these kind of large moves where we broke back above 18,000, got away above 22,000 here. So when you look at that in context, 27% move over 6 days is one of the bigger rallies. It goes up to here. A couple of these moves up here about the same level, coming off of a significant low point there. And we'll see if this ends up changing the tune for Bitcoin, and we ultimately start to work our way higher again. We filled in the gap between the 50 and the 200 week or day moving averages, with a very strong PPO, and we are now getting closer to being back up to the 250 week moving averages. Are we going to find some resistance there? Of course, that remains to be seen. Let's take a look at that asset class comparison chart and just look at here just what happened this week. It was a 4-day week because of the holiday on Monday. You can see the rally in equities late. Still did not get the S&P above 0, but the Qs did finish positive. The IWM finished down for the week, down 1%. The Dow was down also for the week. Emerging markets, developed markets were up as the dollar finished the week down. Commodity prices were up and gold was up. So kind of a typical relatively bearish dollar move. Bonds were up early as stocks were down, but then bonds fell, yields rallied, and stocks rallied. So it's interesting that bond yields rallying, and stocks rallying is back to being a thing again. That's been a deflationary relationship. Obviously, it was opposite all last year while we were in this inflationary environment. So interesting to see that pattern play out. You saw it play out just in one day here today. When you look at today alone, Qs were up almost 3%, IWM's up, SPY's up, emerging markets are up, the dollar was relatively flat, and bonds were way down. So again, a big drop in bonds with a big rise in stocks has been the traditional norm for years and years and years, but not this past year, right? When you look at the correlation here, if you look at the correlation of TNX with the, let me move this over. Let me change this chart down here to make it a little easier to see. When you look at the relationship of the yields to bonds, you can see for the most part it stays above 0, but not this past year. For this past year, it's had relatively few periods above 0, and when it's been above 0, it's been short-lived. It's been a lot longer, spent a lot more time and a lot more often below 0. Now we're back above it. So it's that relationship appears to be, kind of peaking. And again, you can see other periods where that relationship peaked. Here, let's go to, let's pull the S&P is right here in purple. So the other periods where that relationship peaked was a peak over here in the S&P 500. You had a little bit of one here at the beginning, this little peak we had right there. We also had a peak in the S&P 500 when the relationship went positive there, kind of at the end of that bullish move. You can see some during this sideways action, it was bullish, and then you can see over here at this peak, we had a big bullish correlation over 10 days, mind you, of the 10-year yield with the S&P 500. So they both kind of rallied together. So again, we're in this inflationary environment. They both are rallying together. In the past, when you've seen, when we were in an inflationary environment, when you saw these kind of little dips, you were able typically to buy them, and then the S&P would rally back up when they went positive again. So I think it's the opposite now. We're able to kind of sell these peaks as a relationship turns positive. For when they do turn back down. Again, more than likely that means yields are starting to rise, long-term yields are starting to rise, and really that's the only way, in my opinion, that the 10-year, that the spread, the yield spread, can get closer to 0, right? Over the last 6 months, you can see just how negative it's been, but for it to get closer back up here, for it to start to rise, that either one or two things got to happen. Either the 3 month has got to drop or the 10 years got to rise. And the 3 month's not going to drop because the 3 month is a reflection of where the Fed's at, and the Fed's not cutting rates anytime soon. The 2 years suggests that the Fed should cut rates, right? That's why it's so down right now. but it's starting to rise again, and then the 10-year rising. Those ultimately, in my opinion, will not be necessarily good. As you can see, that would cause this to rise, and when this rises, when the yield spread rises, that's not the most bullish for equities. You can see even better over here. When we had that mid-August peak, when we started to rise back up towards zero, that was bearish. At the end of March, we had that peak. We started to rise back up on the yield spread. That was bearish for equities. We saw how we had a little bit of a decline here in December on this yield spread rising. A rise back in the yield spread, in this case, because the 10 years rising, would suggest potential bearishness ahead, even over the next, again, as soon as next week, going through and into this February and March expiration cycles, which are, where volatility just tends to be higher over these next couple of months. Let's take a look at the sector rotation. So bear with me 1 second while I bring that chart up. Again, you can see 3 months, industrials, financials, materials, real estate, utilities, and real estate up there. But let's look at just this week alone and see how things have performed in this 4 days. XLC really took off, XLK and XLY. So your 3 big movers, and then you can see utilities, staples, industrials, and financials, which have been big winners, really moved, lagged, and they were actually down pretty sharply for the week. If you look at just today alone, XLK, XLY, XLC were your big winners. Materials help, financials, industrials lagged, and your safe havens down here at the bottom moving lower. When you look at the 12 grid of these sectors together, then you can say, okay, well, we're going to start getting some dark green shading in the green line. Well, you are starting to get, like XLC is really, it's at a 3-month high. It's got dark green shading in the green line. It's starting to move up to the upside. A lot of these financials, industrials, materials have all been kind of flat and closer to the 3-month highs than they are their 3-month lows. Discretionary kind of in the middle, technology kind of in the middle a little bit. Real estate and staples, healthcare, and utilities all showing dark pink shading in the red line. So you can see there definitely is a shift right now in risk appetite towards these safe haven sectors on the daily chart. Let me show you the daily chart first. So here's the daily chart. There's XLK, XLY, XLC. They have the 3 biggest momentum moves right now as we headed into 4,000. And then at the bottom, you have staples, healthcare, and utilities, your 3 biggest relative strength losers, as well as your 3 biggest momentum losers, really moving to the downside. On a weekly basis, you can see those 3 utilities and real estate staples over here are 2 of your biggest movers to the upside, taking advantage of the drop in yields. They tend to benefit from the drop in yields. And you can see energy is moving down to the left, industrials, materials, financials, healthcare, all moving down to the left. Technology, discretionary, communication services starting to make their way up. So there's definitely a clear rotation out of the cyclical areas that were leading the markets to new cyclical areas, XLC, XLY, XLK. You see that in the Market Watch tab. When you look at the Market Watch tab and you look at all the green, Microsoft, Amazon, semiconductors, NVIDIA up there, Google, Netflix. These were all your big winners. There's some more Adobe down here. There's where all the green is. There's Disney as well. But look at some of these other areas which have been so bullish, materials, industrials. There's not a whole lot of green in the healthcare sector. There's not a lot of green in the financials, especially Goldman Sachs down 2.5%. You can see consumer staples not doing so well. Materials lagging behind, industrials lagging behind. We've been trading. We made a trade on Deere in a recent market outlook video. It's lagging behind there. So there's a lot of laggards here. It seems to be a FANG stock move over the last little bit with those 5 stocks. In fact, when you look at those 5 stocks here, we'll use all of these main ones. So it would be the FANG stocks as well as Tesla and NVIDIA, and relate them to the S&P 500. And here, let's go to, I need to do Meta, don't I? Yeah, Meta right there. So there's Facebook. When you look at the daily chart, there's their moves, right? Tesla has got strong momentum to the upside. Nvidia, Amazon, Apple, Google, Facebook's the only one that really doesn't. Microsoft's kind of lagging behind still. But you see the rotation to the upside on the daily chart, even if on the weekly chart they're still in the lower right quadrant. When you look at some of their charts, like for example, looking at Apple, which is the trade that we had on for this expiration cycle, it's up against the 50-day moving. It's basically filled in the gap between the 30 and 50-day moving averages at the bottom of the value area, strong volume up above where we're at, and a peak in the histogram already. You look at Amazon, and you say, okay, kind of a similar pattern. It hasn't quite filled in. It's gotten above the 50-day moving average. The MACD's already peaked, and you can see again the strong volume you have ahead of you. Google, another stock that did really well today, breaking out above the 50-day moving average. MACD about as high as it's been for most of this year, and you're heading up into some volume resistance at this node, as well as these previous highs over here, filling in that gap. Microsoft, another FANG name, are at a very significant resistance level at the point of control. Tesla, sitting at the 17 and 30 week moving average with a MACD that's already peaked, basically filled in that gap there. Nvidia, chip name, again trying to get above its point of control and above the 200-day moving average. It's done this before, again with a MACD that's already peaked. So you've had a lot of momentum and a lot of these names that got you to these spots. The question is whether or not they're able to carry that momentum forward into like next week, or was this an options expiration rally in these bigger names that towards resistance levels that will fail, with strong momentum that's already waning into that resistance that will ultimately fail in the next week or two as they all go through their earnings announcements. That obviously remains to be seen, but I would lean towards that side of things more so than I would that we're starting this new breakout move to the upside. All right, so for our trade idea of the day, I wanted to take a look at Gilead Sciences. It has really been doing very well after going into its earnings announcement in the fourth quarter, and then afterwards it took off to the upside. And it's been doing very well, as I said. But it's been pulling back lately, and you notice we've been kind of breaching some of these lows over the last couple of days. We breached through a lot of these lows over the past couple of weeks. We got dark pink shading in a red line as the intermediate line is now in bearish territory. You look at its weekly chart here, and you can see we've been in transition mode for quite a while, and then finally got such a big gap between the 50 and 200-day moving averages, bigger than we've seen on this stock in a while, right? All the way out, 10 years, has to go out to 2014, and we've been this bullish. We've gotten to these levels before, roughly, and then now you got the red arrow, falling PPO, a bearish candle on the MACD. If you look at the 3 green arrow chart for Gilead, you can see we have 3 red arrows, and we've had 3 red arrows for multiple days now. And when you look at the 2-line version of this chart, this is where it really opens up that gap between the 50 and 200-day moving average with absolutely no volume in between. So it doesn't mean we have to drop, but it's really susceptible to a significant decline as there's just no volume down here, down to the 200-day moving average. Again, this is what it looks like on the weekly chart, breaking the 8-day after a big spike in the PPO. Again, one of the bigger ones that you've seen in a while, right? We've had big spikes over here during these bullish runs, and then you can see we can really dip pretty quickly down, in this case, to the 50-week, which happens to be sitting right on, the 200-week, right there around the $68. The MACD is already below its moving average, stochastic's moving lower. So we are really, really susceptible. We've been so bullish. The trend strength was so bullish for so long. You got a 26-day rate of change. It's very negative. We are in the cloud, and there's a wide gap in that cloud. We're starting a bearish trend, a weak bearish trend there. When you look at the Bollinger Bands and the Keltner channels, we have broken below in the last couple of days the lower Bollinger Band, right? So, today we finished above it. We were below it when we were looking at it here on our Market Outlook Live. You finished above it, but a couple days ago we finished below it. And then when you look at the Keltner channels, again, we are pushing below that lower band. You would expect that we'll break out below that Keltner channel. We'll get some green shading here. You can see we had some positive momentum. It's now turning bearish, and we got negative momentum now. on the chart, the whole, when you look at the whole moving average for Gilead, and we have now flipped the parabolic SAR up to the upside. We're easily below the 200-day haul, and obviously easily below the 20-day haul, and we're moving lower with the parabolic SAR flipping to the upside. So there's opportunity here for some bearishness, and because it's such a wide gap, I decided to go out to the May contracts and to buy the at-the-money put, so the higher spread, buy the at-the-money put, and then set my stop order at 50%. So this is what it looks like. So my stop order is 50% of that, so right around the $630 or $660 of risk to the downside, and of course by May expiration. Not that we have to hold it on this long, but if we do make that run down to, what do we say, $68, then we got about a $3,000 reward potential, no matter when we hit it, compared to the $600 risk that we'd take if we got stopped out at our 50% stop loss. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join our website at marketscholars.com for free. Follow us and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.